Today on Resource Talks, we're doing an end of the year review that is kind of different, but really the same. Joe Mazumdar is talking to me about why precious metals really went up this much this year and whether there's more room to grow, as well as how he's invested to make the best of the bull run and how his portfolio strategy might change going into 2026. Time for me to shut up now, though. And Joe, thank you so much for being here.
Thanks very much for the invite.
The pleasure is all mine. I enjoy these conversations to kind of right after Christmas and before the end of the year because it's a calmer period, if you will. So you and I get to talk for hours, which I'm hoping this is going to be the same this time. But it's really not been all that calm of a period in the markets, at least not in the ones that you and I follow, because silver is doing what silverbacks promised it will for the last 45 years, and what nobody else believed it would. But it's here, it's happening, it's now, and it's up nearly, I think, what, 200% this year. It's almost hit $80 just recently. So what's going on with silver? Do you trust the run up? What are you seeing?
Like as some of silver's demand is obviously on the tail of gold, and it's sort of like a higher beta precious metal than gold. But with the growth in these carbon-free technologies, there's been more silver consumption on those, like I think for solar, and that so there is more industrial demand. But what we've noticed is, there's been deficits running in the silver market, and so deficits for me in the gold market don't really matter because gold's completely different. In terms of supply and demand and what drives it, and there's so much gold at the surface and gold is held as a monetary tool. Silver isn't, but silver, I don't know if it's half, but a proportion of it is related to the gold price. But then silver's got its own thing with respect to industrial demand. So that deficit does play a role in part of the demand for silver. So from what we've seen is that some of the graphics that I've presented to you, like in terms of the gold silver ratio, like in the first part of the year, the gold to silver ratio got up to about 105. And then since then, it's been declining, but then it had a steep fall near the end of the year. And I think now it's, around 65 or below, which is very encouraging. But that was the increase or the accelerated price increase in silver over gold over the last part of the year. And more recently, even more so. Mm-hmm. And so that might be a little bit of a squeeze happening in the silver market, like a lot of people had promised us for 40 years. But it's real and it's happening and it's providing a lot of leverage. So if you look at the evaluations, I looked at some that a friend of mine, Ron Stewart, does for Red Cloud. He updates the enterprise value per ounce. And if you look at it, a lot of the ones that are driving the average, especially for explorers and developers, are silver. Anybody with a silver in their name. They might only have 30% or 40% silver, but with silver in their name, those ones are driving the average, a lot of them. And some of the M&A, a lot of the M&A we saw last year and the year before was for silver producers, in Mexico at that time. And those guys did very well as the silver price ramped up. That was first Majestic with Gato. It was, I believe, Hecla with Silvercrest. And then more recently, Pan American with Juanicipio and Mag Silver. So that's worked out very well because those guys bought it before silver had actually did what it did for most of this year. So going forward, the issue has also been on a silver producing issue has been how many silver dominant assets out there, are there, because that's where the leverage is. So most, silver, as we know on the supply side, it's been constrained a bit by scrap, but a lot of it comes from byproducts. So here's a mine that produces base metals, it's lead, zinc, let's say, and that silver price does not drive what they do. So if the silver price goes up a lot, they might not produce more lead, zinc because lead, zinc hasn't done as well. Mm-hmm. But On the other side is how many silver dominant assets are there? And with the issues that we've had, geopolitical issues that we've had in Mexico, slow permitting in Peru, how many of these silver dominant assets are there outside of those two principal jurisdictions as well?
Hmm.
And so what I've been looking for, if we get to the whole portfolio thing, over the last year or so, is looking for silver dominant assets outside those jurisdictions, because I thought those would be the unicorns out there. And we've done well on one of them right here in Argentina, where I am right now. So yeah, so that worked out very well for me. But some of that was purchased last year.
Hmm. That actually explains a lot. I was wondering, where's this guy? Christmas time in a t-shirt, and I'm
Yeah.
glad I got that answer. I can hear a couple of birds in the background as well, so that explains even more.
Oh yeah. I
Uh,
couldn't mute.
but I do want to talk about your portfolio strategy, and we will for sure. But ideally, I'd like to ask you what price would you think silver tops out at? But that's not a reasonable ask, and obviously, we're very reasonable gentlemen. That's why we're in mining, obviously, after all. But maybe put differently, when you're analyzing mining stocks or updating some of the MPVs and whatnot, what price assumption is kind of the highest that you would dare to use for silver? What is the price that you would plug in? You wouldn't plug in the spot price, or would you? Or would you plug in higher? What's kind of that price assumption?
Like there's different prices that are used for models. You have the price spot, like you say, and if you were a brokerage analyst trying to keep a buy on a stock when it's run up quite a bit, spot might be what you need to use to show that you still had a 10 to 15% return and can call it technically a buy.
Yeah.
Um, the other one would be if you're looking for debt. And if you're looking for debt, you might have to use a trailing average of silver, which might be a lot lower. And it might, justify hedging some of it, at these prices. Another price might be, you're forced by the exchange to use an average. That might be 3 years back, 2 years back, or something like that. There are different prices, and then there's the consensus prices that people use, the forward curve, that sort of stuff. You can put that in and keep changing it. When I'm looking at assets, I'm thinking more about where this thing could fall in the cost curve so that it can survive any kind of volatility in the market.
Mhm.
So when the silver price actually does go down, which it inevitably will, as commodities are cyclical,
Blasphemy. I
does
think it's
this?
only going to go up. I think
Sorry?
silver. I was just saying, just blasphemy. I think silver only goes up. That's what I've been told.
Yeah, yeah, okay. But in terms of picking the assets, that's where, they might not provide the best leverage, but they'll provide, for me, at least some protection under the volatility and also an underlying thematic that they might be the project that gets taken out and are, you know, uh, or makes sense to build. Because they got the right people, and this is a project that can get built, should be built, and can survive, the volatility. You don't want a project that just makes it under this price. Granted, on the equity side, it might work very well, but you have to understand the dynamics that, but don't get like high on your own supply thinking that, this project makes sense to build. When they start like you know uh, buying their own propaganda, let's say, then that's probably the time to sell that project and move on to something else, because that project, may not be worth building. Might not make any sense to build, might not get enough funding because other people looking at it technically might not think that it should be built. But on the equity side, it might still have run up because, as we know, the more leverage you have, whether you have high debt or you've got a marginal producer, those can go up. And I won't give you the company, but I'll give you an example. So I do a little bit of side work outside the letter, and people ask me questions about companies which are outside the letter, which I don't sort of comment on. But on a private basis, I could do a little, dig deeper for them. And what I've noticed is people are asking about more leveraged plays. What are the flaws in this? So at least you go in there with your eyes wide open. you know when to sell. You know it's going to go up, probably, hopefully. As long as you believe the silver price or the gold price or whatever is going to go up, this will probably go up, and it might go up even more because it's coming from a lower base. So the percentage increase will be much more.
Mhm.
But there'll be a liquidity issue when you want to sell if it doesn't, because everybody will be going out that door at the same time if the silver price drops or the gold price drops. But you might have an advantage in your back pocket knowing that this project will never work. And once they talk about developing it or talk about funding it, you should depart earlier. Take your winnings and go. And don't keep that volatility in your pocket because it might burn a hole in it.
Does it have to then work at like what half of spot, or at what price does a project have to
Well,
work for
you
you to be
you look
interested
at
in
the
right now?
cost curves and you see where projects are, and you sort of want to be in the lower half of the cost curves, whether it's all in sustaining costs or something like that. And then also you probably want to be in a decent jurisdiction. So if it's a decent jurisdiction, you could take a hit in the costs, which are usually labor or now power. But if you're going to be in a higher risk jurisdiction, you definitely want to be in the lower quartile. You need a high margin.
So it's about cost prediction. Like you wouldn't even play. What about upside? What about if you're determining upside and you're like, okay, how much money could I make on this thing? What is
Yeah.
the higher end expectation that you'd plug in?
Well, here's the thing about upside. There's one upside where you just get a mine plan and you keep changing the price, right? But the problem is sometimes you don't change any of the costs
Mm-hmm.
because some of the costs do will go up because that's the environment you're in. So when gold price does go up, it's sort of going up because people think, hey, I want to store a value because I think these other things are overinflated. So that inflation might go into your costs, whether it be energy, whether it be labor, or reagents or whatever. I don't know.
Yeah.
And supply chains can hurt costs. Like, oh, we just got a loan from the U.S. government to build this project, but we can't buy any of the cheap Chinese stuff anymore. We got to buy from these supply chains, which are 30% higher than I would normally pay, that I would have paid if I'd done the work myself and I got the money somewhere else. So all that can impact your costs. So, grade helps, but then grade can be diluted through mining, especially underground mining. Grade can be unrecoverable because the metallurgy is bad, and the product might not be what you think it is. You might be thinking, oh, they're selling silver. No, they're not selling silver. They're selling a base metal concentrate with silver in it. And you're going, oh, good. Where's that going to go? I don't know. And how much are they going to pay for it? And then there's the payability factor, depending where it goes. And so you got to really think about what the final product is as well.
And
It's
most of the
not
times it's
all,
not silver.
it's mostly not silver, especially with these deeper epithermals that have a lot of base metals. And so people would say, oh, the in situ value is this, this, and this. But what's really the payable value here? How much are we actually going to see?
What I've seen out there recently that kind of rubs me the wrong way, and I feel like you can put it into words why it does, is a company produces 10 million ounces. Someone's analyzing it online and they're like, they're going to sell 10 million ounces this year at $80, cost them 20 to make it, $60 profit. Free cash flow is going to be 600 million bucks, but the company's only valued at 60. Therefore, there's 10x potential like that.
Yeah.
Yeah. So, I mean, it sounds like it should be right. And it's simple enough that even I can understand it, but it kind of rubs me the wrong way. Is that how you would look at stocks, or is that not? Do you think that not works? What do you think about that?
Yeah, but I mean, to understand the mentality of what makes stocks go up and down, because they would drive the market more than I would potentially on some companies. Companies I would avoid, but companies that people are asking me about. Why is that company going up now?
Yeah.
What's driving it? They have no news flow. And then I dig into it. It's marginal. They haven't had a lot of operational success. They're carrying debt that's due next year, blah, 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 blah. But these people are still buying because they're not looking at the financial statements. They're not looking at the history of the operation. They're not looking at, how much is it this going to cost, and not potentially looking at the life of mine. It's a very small asset potentially that nobody cares about. All that might not be what people are thinking. So that stock might go up regardless.
Mm.
But for the investor that wants to make sure they can sell it, because there's one thing about, making a return on paper and recognizing it is knowing when to get out. And so what I do in the letter is well, we do all the due diligence, go on those site visits, talk to management, follow the stock to make sure we're picking the right one. So we're not worried that, if something happens, the management doesn't know how to deal with it or something ridiculous will happen. The return might be less, but the probability that there'll be a big impact, like a fatal flaw that'll show up, is zero for me. And so the probability of those scenarios, if you look at that way, that bottom scenario doesn't exist, you know, uh, with the stocks I pick, which is the idea. The idea. I mean, there might be a black swan issue with the geopolitical jurisdiction, but that's also what I try to avoid.
Jurisdictions I do want to talk about as well, by the way. That's on my
Yeah.
list. But just going back to the type of bull market we're in right now, is this a structural or a speculative bull market? And that makes me sound way smarter than I really am. So what I really mean by that is fundamentally on this run here, what is fundamentally supported versus just a quick kind of hype that's going on? Like should, following what you're just telling me here, should silver be 50 or 80 or 180 an ounce? And what do you think?
Well, I mean, I guess the difference is between a voting machine and a weighing machine, as Warren Buffett says. In the near term, it's a voting machine. People are voting silver up. This is the one they want. But in the long run, it'll be a weighing machine, and the weight will be on the industrial part because as silver goes up, will it be substituted for? Because technically, there's a lot of people smart enough to see that, oh, if silver is going to be this long term, is there a way of creating a technology where we don't need it? And that's the same thing that happened with cobalt with batteries when that got harder to get and was more dependent on the DRC. People are looking at a lot of different, and that's the problem with a lot of battery metals is it's a supply and demand technical risk. On the demand side, they can engineer that specific element out of that battery, if they have to. On the supply side, there's more technologies there that, like especially in lithium, that can extract it cheaper and from lower grade sources than what you're thinking about mining. And so there are a lot of technical issues to critical minerals that can change the dynamics more so than we understand. Because people are constantly thinking about that because what are the next 5 million EVs going to have in their batteries? That might not be the same as the next 5 million after that, because the technologies and that holds back people from actually buying EVs because they think if I hold the car for 10 years, is that battery going to be worth anything? Because suddenly, the parts aren't going to be for it. Or it's almost having like a negative on my mortgage is that, the car's not worth anything because the battery's not worth anything, and I got to stick a new battery in it, but, they don't make them anymore. So that is a little bit of a technical risk for some people buying these EVs
Right.
that are constantly looking for the next. It's like having an iPhone. It's sort of like, okay, do I want to hold that iPhone for 20 years? No. I'll probably sell it in 3 years, or the phone company will give me a new one. But that's basically what you want to do with your car.
Yeah.
And then when we're looking at long-term supply and demand, and you've got mines that last for 20 years, that's the kind of dynamics that are being impacted here. Not so much in precious metals, but definitely in criticals.
Well, with that though, I mean, and assuming that this is kind of a real, deficit driven market that we're in right now, where do you expect cracks to start showing up or stress? Like, is it inventories? Is it the premiums or the backwardation contango type
Well,
of?
Let's look at this specifically with a market I'm quite confident talking about because I did work as a market analyst for Phelps Dodge, which is now Freeport back in the 2000s. So the things to look at, back in those days, which is quite 25 years ago, is that the market was easier to see what the global inventory was because we had the London Metal Exchange, Shanghai was just starting, and then we had the COMEX, and then the inventories that companies built up because copper price was what was it, 55 cents per pound when I started working as a trader. The problem was that all these companies were starting to curtail production, like we did at Phelps Dodge. BHP did it. Codelco, because they were state-owned, would accumulate production. So they keep their people employed, but they wouldn't sell it. So they kept hundreds and thousands of tons of inventory at surface. But what they told us, we knew how much was there, so it was visible. So I can look at the global market inventory, and I know what it is within a couple of percent. And then I take that number and I say, well, how many weeks of inventory is that? So in terms of demand, how much is that? And if I got below 4 weeks, the price could spike. In my model at that time, I got below 1 week. The guy who was my boss, who was, ended up being the copper man of the decade, Art Mealy, would look at those models and go, that's impossible. But the problem is we were always underestimating China. We were overestimating the US and Japan, but the underestimation of China just blew that model apart. And so I was getting these ridiculous numbers, and then reality struck when gold and when copper went from 55 cents and hit well over $3. Phelps Dodge doubled. They did a split, and it doubled again. That's the leverage these stocks provide, But what I'm saying is now that's harder to do. It's harder to know global inventories because, especially in copper, 50% of the smelter capacity is in China, and you do not know how much they're holding. You would have to go to every smelter, and some people do that, and that's what you pay for, and find out. But that information isn't available to everybody. And then you have a market that that the consumer holds inventory. So the things to look at in terms of supply and demand for one product, which are concentrates, are the treatment charges. And what's bullish about copper is the treatment charges are negative right now. So the smelters are paying you, the mine, for your concentrate. Why? Because I got to feed this smelter. I can't shut it off. And that's why the Chinese sort of put a slowdown on the smelter expansion in copper because they were they were killing themselves.
Depends on the
Basically,
copper. I'm sorry for interrupting here, but does it depend on the copper concentrate quality? Like, would you want it to be necessarily above 25% and have no nasties, or would they pay up for everything?
You could get finicky, but this is not a finicky market.
Hmm.
If the TCRCs were like 80 and you had an arsenic-rich concentrate, or it was like 15%, you knew there were two smelters in the world that would take it.
Mm-hmm.
And, your treatment charges would be over the average because nobody else wants it. And you had to give it to somebody. That's not necessarily the case right now because now they're negative. But for you, let's say you've got an arsenic-rich concentrate. If I can't blend it, then I can't take it. There is no price for it.
Yeah. That's actually an undervalued or an underrated point that I think is not really talked about in podcasts and anything like that. Because they couldn't put it in the title.
You got to think about the end product that the mine produces. We all think about gold because it's fungible. So it's just a product, that's the price, and it's 99% payable. 99.8, whatever. It just goes to a gold refinery that takes it from 99.7% to 99.99999%. So there's not much value add, and they don't pay you. They don't take much off of what they pay you in terms of a price.
Mm-hmm.
But there's a much bigger difference if you're producing, let's say, gold in what we call a pyrite concentrate or a sulfur concentrate, because then I want the sulfur. I don't. Gold's nice, but really to run my smelter, I need the sulfur to heat the thing up. and I'm not going to pay you for the gold because I can get pyrite from somebody else. So I might give you 80% for it. I might, and then you're doing that because you don't want to build a pressure oxidation plant because it's too expensive. It would take you 10 years to permit or something like that. So you want to just sell the concentrate, but the payability will be the same,
Mhm.
because you're selling it to somebody else. So those are the sort of things you got to look at. You can't just look at, like you said, hey, look at the grade of this thing. It's the highest open pit grade, out there. Nobody look at all the other ones. No one's near it. And they goes, okay, well, what are they going to produce? And you go, oh, okay. So that's why. And then you go, well, will there ever be an M&A bid for that one? Probably not. And then okay, so they have to build it, and and then that worked out for somebody like Pretio. That was pure gold. The big issue was the resource risk. They did 2 or 3 years of that, proved that it made money, and then it got bought out by Newcrest.
Mhm.
Some projects require that. And so when you buy one of those and you're thinking, oh, the gold price is going to go up, this is going to make sense, you're going to have to hold it for a little bit before you get that liquidity moment where somebody buys it.
Hmm. What is that for silver, though? Is that, I mean, just connecting it back to what we just talked about, is there something like that in the silver market as well?
Yes, I mean, because people are looking for, okay, what's the product going to be? Do I have the ability to smelt it? If it's a low sulfidation epithermal thing in Patagonia, and these guys don't want to use cyanide, I got to take it to another plant. Do I own that plant, or do I have to do some kind of toll milling agreement? And those can be very onerous because they know they've got you by the proverbials. And then they'll say, well, it's either us or you ship it out. Take that road out to the coast and ship it to wherever. That's the cost you're going to pay. We'll take half of that in the toll milling. Uh, you know, so that's the sort of thing you got to think about. Where is this going to go? One, you got to go through all the machinations of finding out whether they're actually going to be able to produce that product, which is a lot of detail in itself. But then, okay, where is it going to go? Who's going to do anything with it?
Mhm.
You know, because I mean, that's the problem with a lot of the critical mineral policies out there is that they're looking at the mines, which is good, but then where is it going to go? Is there any point of producing a copper concentrate project in the US if it just goes to Asia to smelt? That's why the new technologies are coming up that are looking at avoiding the smelters.
Hmm.
So when you take it to a smelter, you're not always going to get a negative TCRC. You're going to get $60, $70 per ton, 6 or 8 cents per refined pound of copper that you're going to have to pay out. And then transportation costs, delay in recognition of revenue. What if you had a process that you could actually leach those sulfides and produce copper right there? Cathodes stay domestic, no supply chain disruptions, blah, blah, blah. That's the technologies the big companies are working on. As much as they're looking at saving money in mining with more tech, high energy, looking at comminution circuits, looking at all that other stuff. How do we, tweak this? And because you're dealing with a lot more volume now as the grades go down, those little tweaks make more sense in terms of have a bigger impact in terms of power, costs, and all that sort of stuff that make everything cheaper. But then you look at, okay, I've already got this stuff above ground. How do I extract what's already there and turn it into revenue and avoid reclamation? Like I know there's germanium and gallium in that slag. How do I get that out of there? I know there's some really low grade copper in that run of mine ore. How do I leach that? And then all that sulfide underneath my oxide or my enriched SXEW plant, can I actually treat that domestically and leach it? And that's what the Newton technology that Rio Tinto has been developing for 30 years has been trying to do. I mean, and it's not one size fits all for those kind of projects. It's a long-winded answer, but there you go.
But so would you then pay, well, the number of times for an MPV that you would pay, so you'd pay more more of the MPV for a company that doesn't have to send its final product to Asia for smelting. And it's kind of like you're essentially asking two questions. What are you producing? Is it actually, or what are you selling? Is it actually silver that you make your revenue from? And where are you sending it to? And based on the answers to those two questions, that would determine what kind of premium or discount you would be looking for. Is that right?
Yeah, and the product, like, is it going to be arsenic rich? Is it going to have mercury? Is it whatever? And then you sort of reduce the amount of people that would actually take it. And
Yeah.
when you reduce that, then you get them having sort of the power leverage, the cost leverage, the price leverage over you as a
Yeah.
seller, because there's only so many buyers that you'll get. With respect to what you were saying about product, where's it going to go? So when I look at jurisdictions, and I know you're going to ask me that specifically, but I would say that when jurisdictionally, I also look at jurisdictions that can sell to either supply chain, because as we're segmenting the world right now, you want to look for a multiple bid for this asset. They could go into production. It's got the right people, but it's nice to have an underlying bid in there. So, but not just a Western bid, maybe an Eastern bid. So you want to pick those countries that could potentially have both, and that's where South America comes in.
Hmm.
South America can sell to either one. They can sell into the U.S. supply chain, the European supply chain, or China. The problem is if you get into some jurisdictions like Canada or something like that, it's hard to figure out if the Chinese can come in. That's an issue with some of the uranium assets. The Chinese in a heartbeat would come in and probably buy a lot of those and put them into production. They're not allowed to do that. And they're not allowed to do that in Australia either.
Yeah.
So that's sort of, and then also, if you're a TSX listed company and you want to sell to the Chinese, like what happened with Solaris in Ecuador, you're going to have to change your dynamic, your share structure, your ownership, your management team, where they're located to be able to close that transaction. So all of those are other risks you got to look at, in terms of which company you're looking at.
Hmm. What would be the bear trigger for silver that you think a lot of people might refuse to say out loud? I was just thinking about the joke that I made earlier, where it's like, oh, I've been told that silver only goes up. Of course, it doesn't, and it's going to turn eventually. What is that trigger going to be?
Well, I mean, some of it will be taking money off the table for some, and that might drive some herd mentality to go to the other way. Uh, and so that could have a negative impact, and that should be supported by the industrial demand, hopefully, because the industrial demand might go down, and the scrap supply go up in a rising price environment. Those are the sort of dynamics we'll see because, like we said about gold versus silver, there's much more real supply demand dynamics with silver as opposed to gold. What's driving gold price is people looking at real U.S. interest rates, and when that falls, the U.S. gold ETFs go up. And if you look at central bank buying, that supports the gold price when it actually should come down, because now the banks are saying, oh, we're worried about the tariffs and potential increase in inflation. And if that happens, that usually is a negative for gold. But then the central banks are sort of supporting that gold. So every time it should have slumped, it didn't slump. So every time it flatlined, it was waiting for a new pickup. Then suddenly, well, we're going to have another rate cut. Boom, that went up. And then flatline. When it should have come back, it didn't come back.
Hmm.
Next, another. So we showed three different jumps in the gold price this year. First, Q1, another one around the Colorado Gold shows, Q3's October-ish. And then now, that's been another one. And now has been that people were looking at the reserve chairman and saying, oh, you know what, we're not sure if we're going to get another one. But then they're looking and saying, well, he's not going to be around next year. So, and everybody they're interviewing has said that there's going to be at least two cuts next year. So, boom, we're going again. So that's driving the gold price. Silver will tag along, but then the industrial demand might weigh on it. Just like sort of like the jewelry demand would weigh on the gold price, and increase the platinum price because now people are looking for platinum jewelry and maybe even silver jewelry, you know. But the gold price has got a different dynamic as a monetary issue, diversification and that. But definitely, if there is, a negative with respect to, not a negative, but an idea that rates are going to go up, that'll definitely drive out gold ETF buying in America, in the US, which has been some of the big support. The biggest growth has definitely been Asia, not so much Europe, but the biggest demand source has been the US. Not the biggest percentage growth, but the biggest demand overall source. ETFs on gold, silver, sorry, a lot of what you said, deficit driven. Just like platinum, deficit driven, price rise, because actually platinum did better than gold as well as palladium so far. Didn't do as well as silver, but it didn't have the same sort of speculative bent. There weren't people for 45 years saying that platinum's going to go to the moon. So platinum has just been going on in its own dynamics, and palladium has been tagging along because of the substitution issue. Gold has that substitution issue with silver, but silver might have another dynamic in terms of substitution with respect to the carbon neutral technologies that it gets used for. So there's a lot more going on with silver that could potentially drag it back. I won't say reality, but definitely, revert to the mean.
Out of the precious metals, is which one of the four would you? Well, I suppose there's more, but let's call it platinum, palladium, gold, and silver. They're completely different, in my opinion, in terms of markets, and they behave differently. But which one of the four do you see most potential in right now?
Because how do I put this? I'm not smart enough to know which one's going to do better than the other. So I'm just going to bet on all of them. So in our portfolio, we've got PGE exposure, we've got silver exposure, but the most by far we've got is gold exposure. Why? Because in terms of liquidity, there's more liquidity in gold. There's less in silver, and there's very little in PGEs. So I'm not going to overexpose the portfolio to PGEs, but I'm going to pick the one that I think is the best. I'm not going to overexpose the portfolio to silver, but I'm going to pick a couple that I think are really good. And with gold, it's more liquid. I'll pick more than a couple.
Coppers.
Because the market will always be there. Like if you look at the financings, gold financings, are up significantly year on year. Will PGE financings, be up next year if something happens with the platinum price or the palladium price? Probably not. But if you pick the right project, lower quartile, that can be built, and you have the right people that could build it and put it into production to be sold later, that might be the asset to hold, which is what I hold.
Copper is much more liquid than that. And then I was actually thinking about copper's obviously not a precious metal, so that's not where I'm going with this. But it's I was thinking about, okay, what's underperforming right now and what's more liquid? Because the things we're talking about are not very liquid on the whole, although gold might be, but silver is not that liquid. And it's already done very, very well this year, whereas like copper is up, 30-40%. Yeah. But then there's also other stuff like nickel. Oil is not done very well either. I know you don't necessarily do oil, but is there something else? What do you think could be the next bull market here? Is it copper, nickel, oil, something else?
Yeah, well, I'm looking at, and this is an issue. I talked to somebody else about this earlier, is that the markets are going up and blah, 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 blah. Is it time to take some money off the table? And then I'm looking, well, I sort of got out of my way to pick these certain companies, to have protection if the market does turn. But then I'm thinking in terms of an M&A bid, they can still get bought. So I continue to hold them. If you do not pick the right companies, let's say, and you're picking leverage, this might be a top. This might be a place to take money off the table. Whether it might be the metals or whether it might be the companies. But in terms of the companies, there's at least other companies to put your money in that might be higher quality. Uh, you know, um, if they fall, you should buy those. That's always what you should have in the back of your mind is do your homework and then pick certain companies. And when they do come back for hopefully the wrong reasons, you put your money in those. Uh, the problem is a lot of people put it in the leverage, tends to be marginal assets that have a hard time raising money. And when they do raise money, the equity that they raise is usually high cost. They put a lot of warrants on it or something like that, or raise at a discount. A lot of the companies in our portfolio did raise money, not once this year and not insignificantly, but some companies raised twice and significantly. Why? Because the market was there. The question is, will the market continue to be there? Because when I did a graphic, let's just say for companies in one jurisdiction, which was British Columbia, and if you looked at that and you look at the returns for these 75 companies that I found that operate in the province, the average returns underperformed the GDXJ, but the top 20 companies outperformed the GDXJ. And these were mostly development companies. One of them went into commercial production, but everybody else didn't do so well. And everybody else didn't raise a lot of money. So the ones that could raise money, that had the liquidity, and this is the asymmetry of the market, they got it all. And then that's why you have this dichotomy sometimes when you talk about the market and you go, oh, it's great. Everyone's raising money. And then you have this one guy in the corner that says, I couldn't raise anything.
What about you though, then, Joe, in that case? Like how did your portfolio change to reflect those, I suppose, changing market conditions this year, right? Was there a lot that you changed in order to perform? Did you perform well? So yeah, talk to me about what you did with your own money this year.
So, I mean, in terms of performance, it's obviously, I mean, I'm not, trying to boast or anything like that, but we've done well. But the outsized returns was an M&A of a royalty of a company we've held for quite a while. And that was like, 15 times. We had two positions. One was 15 times, one was 4 or 5 times. And then we sold that one and kept the SpinCo. And that SpinCo had gone up another 70% since it came out. And in terms of the other companies that have done well, they're more recent buys from this year that were silver, and jurisdictionally was one that I think is going to improve, which we can talk about. Copper in Kazakhstan, I think you have been there.
Yep.
Silver in Argentina, which is one I talked about, and then PGs in Brazil. Those have done all very well. But another one that did really well that I bought a couple of years ago is rare earths in South America. That's done phenomenally. And that's a very small market. It goes back to my point that it's not a big enough market that I would just go nuts and change the whole portfolio into rare earths. But I realize the market that exists for it now, trying to refine which company I pick. Took a lot of time, took a big site visit tour to pick it, but I was very happy with it and continue to hold it. But for the longest time, it wasn't doing anything until mostly this year.
Yeah. Rare earths in South America, that's Brazil, I assume.
Brazil and Chile, yeah.
Okay. Interesting. Yeah. What was the biggest percentage gainer that you had this year?
Well, I mean, closing, or you mean year to
No, the
date?
money you made. So, or well, maybe if you haven't closed out that position yet, how high is it now?
Uh, this is open positions.
Oh well, no, it doesn't matter. Like if you close that 10x position, tell me about
I
that.
mean,
Or if you have an open
technically,
position
this
that's
is the
more than
issue we
that, tell me
always
about
have
that.
in the letter to talk about, how do we calculate return? So we have the closed positions, and the biggest closed position from last year that had the biggest return would be that royalty company, that junior royalty company. And in terms of companies in the portfolio, the biggest one would be a silver developer and a copper developer. Those would be the biggest ones.
What are we talking about though in
Topic.
terms of return? So is it a 10x? Is that something that you think is
Oh,
attainable
no,
right
no, it's
now?
more like a triple.
Okay, good.
Yeah,
Yeah,
yeah. It's a
interesting.
triple where the GDXJ went up 150, that went up 300, 350.
Right. Oh, that's good.
Yeah. But that's the problem is that some of these things, if you want the 10 bagger, that's a little bit of a longer wick. You would have had to start it off earlier.
Yeah.
Like another one that's done very well, which is I think a four bagger or five bagger, was one gold in Australia. A developer, Advanced Explorer in Australia. That's done very well
Hmm.
as well. But I'm just trying to beat consistently the GDXJ on the precious metal side. That's how I benchmark myself. And when it goes up 150%, it's got to be pretty good. The problem with exploration is it's not leverage. Like if the gold price goes up, it's not as if your exploreco is going to go up because it'll go up more on a good drill hole. But the cost of capital goes down because now if it needs money, it can raise money. The problem is when you get an explorer in a bad market and it doesn't hit anything, it's constantly raising money at lower prices, and then you get the liquidity trap. In a good market, doesn't mean that stock's going to outperform. It still has to drill and get good results. And so that's another thing I look at is not only can it raise capital, how much is it spending? Not that let's say, oh my God, they're spending $20 million this year. That's great. But oh my God, it's cost them 1 million or 1.5 million per hole. That's not what I'm interested in. That's why I'm looking at how much it costs people to drill per meter. I constantly ask people, well, what's your budget to drill? You know, how much of that drilling is effective? Meaning that how much do you have to drill 800 meters to get to where you want to get to? And then how many of those holes can you drill in a year? How much do you have to raise to do that? Because if you don't hit that same hole, it doesn't matter what the copper price is or the gold price is. You might be raising at the same or much lower price than you raised last time. Uh, so those are the sort of things I think about with exploration companies. It's not only the land package size, what they're looking for, the infrastructure, if they could build it, and the infrastructure, a good infrastructure like what you saw at Kazakhstan, means I could have a lower cutoff grade, means I could have a lower head grade. But if I'm looking, at the Andes, which is still quite a distance from where I am here in Argentina, um, you know, I'm going to need quite a good head grade, especially if I'm in the Argentine Andes and I have to take it east. I know right now, with the election of a right-wing president elect right now in Chile, he made his first visit to Argentina with Milei. There's talks about can they start taking mineral west. I don't know how long that would take. This president, new one, will only be there for 5 years. But that would be a huge boon for those projects that are in development stage, whether it's Los Azules, Pachon, potentially the Vicuña district, all that sort of stuff, to take it west as opposed to east.
Hmm.
That would be a big, big deal.
I'm still kind of disappointed in trying to work through what you said earlier, which is that I shouldn't expect a 10x that quick. I thought it was you just buy a stock, they do a drill program, and you get a 10x. That's kind of what I was promised.
Well, you could. I mean, there was a company in British Columbia recently. I don't know if it was a 10x, but it was significant. It was 4 to 5 times big, but you were
Yeah.
coming from a micro price. And then they hit an intersection, and then the stock went wild. And then actually, when they released the results, it didn't go up until people started finding out about it the next day. So if you saw the result, saw its market cap, you could have bought it, and then people were piling on later.
Yeah.
But it's got its issues, whatever. But that company was having a hard time raising money before that.
Mhm.
Nobody would give money. So that's the Explorer play. People weren't giving them money. They're going back. Obviously you want to see where they were drilling before to make sure they weren't re-drilling a hole. But it just goes like, oh my God, let's go. And then people just pile on. Is it something I would add to the letter? I don't know. I've got a call with the guy later this Christmas a break between New Year's. But whether it's worth it, I don't mind paying more, knowing that it is something,
Mhm.
as opposed to chasing it and then finding out it's nothing.
Yeah. I visited one of those BC stories this year as well, which also had a similar trajectory to the company you were talking about. A little bit different, but it also had I mean, it did well that way too. And I was only half joking. I think explorers are often, or at least for the most of us, they're kind of like lottery. I think there's a few people out there who know how to do it well and have done so consistently through bear and bull markets. Looking forward, though, what do you think is going to be your best performer from here on out? What are you going to be chasing? I'm seeing, and really, I'm going to extend this question to a bit of a rant, but I'm seeing more and more M&A. I'm seeing more combinations of companies than I'm seeing acquisitions, really. So more M's than A's. But is that a strategy? Should be a portfolio? Should that be a portfolio strategy going into 2026? Buying stuff that you think are takeover targets. Is that something you see as having good potential, or do you see something else as having more potential?
So I wouldn't take it as a strategy. What I would take it as a mental construct that you have to have the idea that it could be taken out, because if you keep that construct that it could be taken out, or it could get debt, let's say, from a bank, that there's a certain level of due diligence required for that to happen. And if you apply that kind of due diligence in your head, you'll always be picking the right projects and potentially the right people.
Mm-hmm.
Because the right people might be with the wrong project, but still make it work. And the wrong people could be with the right project and still not make it work. And that's a problem for us as equity holders. When I worked for corporate development for Newmont, that wasn't an issue because we would end up being management. So the quality of management mattered less than the quality of the asset, right? And so when you think about M&A, you got to think about the quality of the asset. Is this something somebody would want? Does it have the size? Does it have the life of mine? Is it like not going to be hugely capital intensive? Is metallurgically, is it going to work? Is it some kind of metallurgy that's only lab level that nobody will want to do? Is that what makes it? That all that sort of stuff is what a potential suitor would think. You don't necessarily need the M&A to get a liquidity event, but if you have the mental construct of picking the right ones, you can still do well. And what you really want is the one that does well and then gets taken out, because the takeout might be a 30% premium, but hopefully it's over a 200, 300% return for you. All that's doing is generating a liquidity moment for you. And then you walk away. And in this market, you might even keep shares of the suitor, like I did with that Spinco company. We got cash and shares of the bigger royalty company. I kept that. That kept going. So my return is actually higher than what I told you.
We are actually maybe seeing a bit of a de M&A happening as well. I mean, you talk about it in your presentation at the Rural Classroom. What Newmont, what $4.5 billion plan to divest of assets, which you talk about, buy old major assets, optimize, re-rate. We've seen Discovery Silver, we've seen Fuerte do that, other companies like that. Is that going to be a strategy going forward?
Yeah, because I mean, we're taking two different strategies here. One strategy is Newmont. They had debt. Their shareholders were telling them to clean up their balance sheet. One way of doing that is using your own cash, paying it down, but then that's the cash that they want in dividends or share buybacks. And that's the other thing that was been happening, is returning more to shareholders. That's generating more demand for their shares. So that's one thing. But how do you generate the cash to do that? Well, you generate your own cash, free cash flow, which has been expanding, but also free up management. Lower your own G&A. Well, how do you do that? Well, let's get rid of some of these other assets that are just taking up time that don't make much money. So let's focus in on the big ones that drive everything. And all these other ones that are on the satellites don't matter. What you can get away with in
Yeah.
Nevada is by having a lot of central processing plants, is these things which would be individual mines for somebody else is now the Nevada gold mine complex.
Yep.
So now we call it one mine when it's not one mine, it's a bunch of mines. We did the same thing at Phelps Dodge. You call it Naomi, North America One Mines. So, to try and basically mask individual performances of assets that were really running by themselves. So what you tend to do now is like what's that asset in the middle of nowhere that jurisdictionally we're not in? We got to carry this G&A. Do we really need to do that? No. Well, let's pitch it. Okay. What about this other one? Are we overexposed in this other area? Yeah. Well, in this market where the gold price is going up, there's a bid for those assets. In another market, there may not be a bid for those assets. And so they sold a lot of it, before, but they were selling it to the Chinese. They were selling it to smaller intermediate companies that wanted to grow, but they wanted to buy a producing asset. They didn't have to worry about permitting. They didn't have to worry about capital cost escalation because a lot of companies were having those issues. So they weren't into development. They wanted to buy producing assets. And that was an overhang on the entire M&A sector for people that held development assets. But if you look at the tail end of that, and this wasn't an important asset for them, that wasn't driving the $4.5 billion divestiture. But the Coffee project, which is the open pit heap leach project in Western Yukon, was no bid. They couldn't sell it. Nobody
Hmm.
wanted it. So it took a change in the market, a significant change, to say, you know what? That might be one that makes sense in this market. So guys got together and they didn't sell it for much.
No.
I mean, and they didn't really get a lot of cash for it. What they did do is get it off the books in terms of the liabilities and any risks associated with it. Boom, it's gone. That's another big issue for them is what they carry in terms of liabilities on these assets. And I know from my experience, every quarter we had to talk about that with a bunch of people, and it was a pain in the ass. So you want to make it clean as possible. And you were talking about divestments. And so now what we see with Barrick, the same thing happening. You have an activist investor coming in because everybody's talking about gold. What's the big gold companies? What's the ones in the US? Barrick is one. Okay, but we don't like all the stuff in Africa and we don't like this big copper gold project in Pakistan. So why don't we split the company? So then probably the former CEO wasn't probably in love with that idea, departed very quickly because he was doing the Colorado Gold shows. He was there.
Yeah.
And then, in a couple of weeks, he was gone.
Hmm.
So you take that, and then we talk about almost like what I talk about for my subscribers is a bit of a de-Rand goldification of Barrick. Basically, you're taking all the Africa stuff and potentially putting it in a different portfolio, putting Rico Dick in there. And then where do you get the bid from that? You're not going to get that bid from probably Western companies, but you might get that from the Middle East. You might get that probably from China. You'll probably get somebody else bidding for that. But on the other side, you're going to get, the majority ownership of Nevada gold mines. You're going to get 4 Mile, which is 100% Barrick. Was it somebody put it at 35% of their value going forward? Incredible deposit. So those sort of things you put together, who does that make the most sense for? Newmont. Because they get Newmont back. They get Nevada back. The dumbest thing that they did was to give up operatorship of Nevada. But everything else that they've done has increased their share price, their policy on dividends, share buybacks, generating free cash flow, not overexposing themselves to high geopolitical risk jurisdictions. That has done well for them. And they've outperformed Barrick in that sense. So now it's sort of like the deal has gone the other way. Now it might be Newmont's turn to now they have a new CEO. coming in. Yeah, I think that's the way that one's heading, I think it makes a lot of sense because it's not about growth for these guys. It's about generating the most free cash flow you can and giving it as much as you can to generalist investors. So they don't have those. There's not a lot of institutional equity out there that's just precious metals anymore. There's a lot of family offices, out there that like precious metals and are looking, but they're doing their own due diligence now. They're not giving their money to anybody anymore and paying any fees because, and a lot of these guys aren't outperforming the GDXJ, that went up 150% or whatever. So now what these guys are looking at, what else can I invest in? Liquidity matters for some of these people, because a lot of these people made a lot of money on AI. Silicon Valley has done that, and a lot of these venture capitalists are looking at critical minerals. But the liquidity isn't there for all these smaller companies, but it is for the bigger ones. For all these other guys that are putting money in, whether it's the governments, that help Trilogy and South 32 with the asset in Alaska, are also supplying a lot of capital. There's different sources of capital coming now for projects that have different mentalities on what they think value is. So if you go in thinking that value is this, it's not what those guys put their money in for. Like it might not be the same reason Tether is in Elemental. A junior cash flowing royalty company that did a merger with EMX that we owned. So we continue to own that one. But, you got to think about the construct also of the share structure and who owns what, and what's driving their strategy. You might have an idea, but, you'll never own enough potentially to ever drive to make a difference for their strategy. Mm-hmm. Like they'll talk to you. Like they'll talk to me, but I can make suggestions, but I can maybe have more influence on a exploreco than I'm going to have in a bigger company that's, owned by an activist investor or somebody else.
I am still thinking about the D-Rand goldification of Barrick, the term that I think you coined there or just brought up, which is interesting because these assets are eventually going to end up maybe in different companies, just kind of like what Newmont is doing or has done. When majors when they sell, are they mostly selling those low margin distractions? That's kind of how they sell it, or are they really selling headache? Politically permitting, political headache, permitting headache, metallurgy headaches, whatever they might be. So are those things bargains or are they booby traps? I suppose. How do you see that?
It's I hate to say this, but it's everything. And it all depends on the timing. I mean, let's say if we go back to the Newmont thing, that was a strategy. That was, we've got this debt. How do we get rid of it while conserving our free cash flow to increase shareholder returns through dividends and buybacks? Well, how do we do that? Divest. What are the impacts of divestment? Cash in, headache out. Headache doesn't mean only, this was a problematic asset, but this is an asset that we spend too much time thinking about that doesn't generate much on the portfolio. It could generate something for somebody else's portfolio. And this for us is that for them because it's a much bigger thing because they produce 500,000 ounces a year. We produce 6 or 7, and this produces maybe 150,000 ounces. For them, it's material. For us, it's not. It could be as simple as that. And that's a bargain. And that's what the intermediates should be buying. The problematic ones could be, oh my God, this is big, this is nice, but this is gonna take a long time to build. Something like that. Mm-hmm. Or this is a liability that the new asset that looks like a short mine life, something that I don't want environmentally, the impact. I don't want anybody talking about this. So I'm just going to get rid of that. I don't care. And then I'm willing to sell it for nothing because really I just want it off the books. Mm-hmm. It doesn't matter to me. And so when people think that, they're waiting to make a return on the equity, a lot of times when I bought and sold for the company, It was because we wanted the asset. When we stopped wanting the asset, the return on the equity didn't matter because we were looking for something that would be material in the asset. The idea behind the share return wasn't part of the overall strategy.
Yeah.
It was just about, okay, well, why do we still own shares of this company? Get rid of them. We don't need this. It's not like, oh, I'm going to wait for the next catalyst or something like that. Sometimes you have to do that, but you're looking for more for a liquidity issue. When I sold, I would just sell over months. I'd let the company know you got a month to find me a buyer, and then I'll start selling. You know, uh, and I don't really care about the return.
Hmm.
But now, what companies are finding, like with Agnico and that sold Orla, that share position basically gave them a lot of inflow of cash, which they used to deploy into more companies. One of them was Perpetua, the Stibnite
Yeah,
project
yeah,
in
that's right.
in Idaho. Yeah,
Yeah. I'm just thinking about the strategy of buy the buyers, the mid tiers or the bigger small companies, if you will, that are
yeah.
buying the
Well,
assets.
the buyers, the intermediate companies in this kind of market, if you're a strong believer in precious metals, will provide you the beta, the leverage, at the same time potentially do the M&A. They'll dilute, but they'll grow.
Hmm.
And then people will look at them, oh, they're going to fill this new space. And there's this liquidity thing that goes on that as these guys that are big investors, they can't invest in companies less than $1 billion, some of them.
That's right.
So it's almost like these guys have to breach this threshold to get noticed. And when they get noticed, then you strangely find that they keep going up because now these other guys think that they're a bargain. You might not think that they're a bargain, but these other guys think that they're a bargain because they're looking at the valuation of these other companies. They go, wow, this is cheap. I'll buy that. And they can deploy a lot more capital than we would be able to.
Hmm.
So we might make the first three bagger, four bagger, but these guys are just looking for a double. And
Yeah.
the next guys might be only looking to outperform the S&P, but they'll put a lot more money into it. And then suddenly this becomes a very liquid stock that trades, millions and millions of dollars a day. But if you look at the footprint these guys have, these big investors that made a lot of money from AI, whether it's the venture capitalists or other investors, is in the mining world, it's hard for them to invest because the liquidity is not there. There's only a few companies that they may be able to own because they'll own too much of it. Their minimum investment would be too much of a chunk of that company. And they can't own a bunch of little things in a lot of companies. That just doesn't work for them.
Yeah.
So when you get to the next step for some of these intermediates and merging, and they say, oh, you know what, and then doing a main listing in New York or on the NASDAQ, and it's a big impact on some of these companies, to show that, oh yeah, we're a NASDAQ listed company. Like that's what Elemental did. So they had an OTC listing. EMX had an NYSE listing, but together when they merged, they went out of their way to do a share consolidation, get the share price up, show the liquidity, and now they trade on the Nasdaq. And the Nasdaq's done very well for another royalty company like Royal Gold. So, and then Tether is one of these tech sort of companies with stable coin. So that's the kind of exchange they can talk to their own investors that invested in Tether or any of these other things that they have and say, oh, you should invest in this one. It's listed on the NASDAQ as well.
Yeah. 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 It's many different ways to skin that cat there, I suppose. In terms of strategy for 2026. But it seems like these assets don't always unlock, or these transactions don't always unlock the underlying value in the assets. Sometimes maybe they just kind of repackage risk, if that makes sense.
You mean in terms of the junior? Now we're talking about the risk profile and what does the junior get out of it?
Yeah, yeah,
In
exactly.
terms of buying these divested assets, whether it be Discovery Silver,
That's
I
right.
forget,
Fuerte. Yeah.
with the one near Timmins. I mean, even Blackwater, that was Artemis. That's done very well,
Hmm.
buying that project and then restarting it. I forget who had that. Was it I Am Gold? I can't remember who had that. New Gold. It was New Gold that had that project. They couldn't build it. They didn't want it. And then Blackwater has become a phenomenon. Part of that is a rising gold price. It was low grade, hard rock, cheaper power. Uh, so that ended up working very well in that environment. For Discovery, their problem is that they had a silver asset, which should have been a good idea in the silver market, but it was open pit, and Mexico had a problem with open pits. And so
Yep.
by doing this asset and rebranding themselves, and they hadn't even really changed their name at that point very well, they're now a sort of a 1 gram bulk tonnage deposit in Ontario, which definitely did well for them. That was a bit of a strategic move for them. The Hemlo thing, where Barrick said, okay, this has got, I don't know, this kind of mine life. This doesn't really matter to us. We don't have anything else in Canada. Let's just pitch this. They got a buyer for that. In this kind of market, they could find a buyer for that. Last year, they might not have found a buyer for that because that buyer might have been interested in the project, but couldn't get anybody else interested in raising the capital to buy it. So they might have paid less for it last year, but they might not have been able to pay for it at all. Uh, so now they've got the money and they can raise capital in this market. So Hemlo producing asset, already permitted, tailings facility, underground, and you go in there and you keep producing. And hopefully you do more exploration. The theory would be that Barrick didn't do a lot of exploration. They were just running this mine into the ground and looking to reclaim it, whatever, in 5 or 6 years. So here we go in with a big program and we could show an increase in mine life. So that's the idea. I mean, recently Talon did the same thing with Lundin. So Lundin sold the Eagle mine, nickel and copper, in Minnesota to a smaller company, Talon, that has another nickel and copper asset in Tamarack. They have it in Minnesota. Their project, sorry, is in Michigan. The Eagle mine's in Michigan. So what does Lundin do? Well, Lundin strategically, and I visited their asset, Caserones in Chile, more into copper now, bigger emphasis in South America. They've divested a little bit of the Vicuña thing. That's a new company, but they're investing a lot in exploration in Caserones. They've done very well at Candelaria. They've had history of success at Chapada. So now the idea is focused entirely on Caserones and grow that mine plan. But they're still interested in critical minerals. They're still interested in that exposure to the US. So they've done an all-share transaction where now they own 19.9% of Talon. They've taken board seats. So now the CEO of Lundin Mining, Jack Lundin, is now on the board of Talon. The general manager of Eagle Mine is now the new CEO of Talon. So now they've integrated these companies and created a bit of a critical mineral company in the US, which makes sense. Do a share consolidation and then do a major listing on the US and create that champion there. And so that's a bit of the strategy that people will employ in this market because of what's happening in the background. New US funds for critical mineral projects, lower cost of capital. But when you do that, you got to make sure as an investor, you're not investing in a project that's on this part on the high end of the cost curve, because the problem is all this dynamic can't change the price of nickel, can't change the price of copper, can't change the price of platinum and palladium. That's still a market price. So you still want to be on the lower end of the cost curve. So those are the sort of things you want to think about. So even though you get cheaper cost of capital, it's still got to make sense that you can actually the asset can produce revenue that can still go, create a definite margin that makes money, because we're still in the West where we still need to make money.
Yeah. Yeah, that's right. It's also making me think more about exploration, just straight up exploration the way we know it, and whether we're going to see more of that in 2026. And really why I'm thinking about that is, the market rewards exploration better today than it did maybe 12 months ago when we would have done a similar interview, you and I think. But is that going to be I mean, is that a knife with two edges where on the one hand side, it could be a lot of worthless projects that are going to be promoted as the next great, greenfields discovery. Do you see that as a major risk?
Yeah, exploration is always a risk because, I, as a geologist and more technical people, hopefully we have the hubris to know that, we don't know. All we can do is reduce the risk by picking the right jurisdiction, picking the right management that has access to capital, picking the right property that's lower, more cost effective to test, and potentially will generate, has a big enough land package, let's say. Those components, but we don't know what the drill bit will give us. We shouldn't know. Otherwise, we're re-drilling an old hole.
Mm-hmm.
So that sort of stuff will always be a risk. But you try to, you know, mitigate as much risk as you can through management, through jurisdiction, through capital structure, access to capital, that sort of thing, and picking the right commodity. So if you pick illiquid commodity, you know, that's got no bid, and then there's just no impetus for them, their ability to raise capital is harder, and that just makes the share price sort of sit there. So all of those sort of things come in, especially for exploration. But, in terms of what I'm going to do in 2026, a lot of that will be advanced exploration, exploration and advanced exploration. So some of these guys will have deals with companies like majors. And I always look for that as a part of the portfolio to say, okay, even if the markets go to pot, they'll still have news flow because this company's earning in to one set. So I can leave that alone. And all I have to do is worry about raising capital for this other one.
Mm-hmm.
That's the sort of thing I would look for in, let's say, a grassroots explorer usually. With respect to advance, some of the stuff that looks risky to me that I've stayed away from normally that I visited recently, which I can't talk about, is, I mean, this thing could be huge. And huge is what the big companies are looking for. So that's a completely different mantra. So one, I might be looking for something huge where the company is paying for, which is fine, and they end up with 30% of hopefully an asset for a large copper company. The other one might be better for a tier two company or developer that, I don't know. But, they can get results, they can create tonnage, blah, 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 blah. This other one might just be like that asset that was bought by that we had that 15 times return, which was a 1% NSR on the Silicon Merlin project. Silicon Merlin went from zero because nobody knew about it. Anglo Gold, Ashanti drilled the crap out of it, 4 million ounces at Silicon. Then they found another deposit, which was 3 times bigger. All of that made that royalty worth a lot more without this company putting a cent into it.
Right.
So that's why I own some cash flowing royalty companies. But what I don't want to do is own a cash flowing royalty for beta. I want them to continue to generate royalties because that's really where the alpha is.
Mm-hmm.
And in what I do is I'm constantly looking for the alpha. But to have a little bit of the beta in the background that gives me access to capital that they don't have to go back to the markets is good. I don't need them to make twice the cash flow. I just need them to cover their G&A and cover their prospect generation. And hopefully they'll capture something that'll deliver the alpha.
That actually goes back to another one of the points that you made in that presentation during the root classroom, and that's the sentiment evidence, if you will. So
Yeah.
it's there. I mean, the room's filling up again, figuratively and literally as well. So more retail interest. That's also where explorers get rewarded more. That's where what I just said comes from. There's just more people. The room's filling up again.
But I mean, the problem is that when you're looking for a project, company, asset, like I told you, like I'm getting a lot more requests about other companies. And so we're creating more companies, which is not always a good thing. So it's harder to pick in a bull market because you might look like a genius, you pick this one, everything goes up, but it's hard to pick quality in a big company because you're sort of you're not necessarily for me because I've been in it long enough on a technical aspect, jurisdictional, I could filter better, hopefully. And then also management wise, I can filter better. I live in Vancouver and I see a lot of these people. Um, uh, but it might be harder for somebody that's just dipping their toe into the sector, seeing the returns, goes, oh, my friend just made a 10 bagger on this thing. Which one do I go on with? Oh, this one's only $5 million. God, I'll put 20 grand in this, and then they get disappointed and then they're not in it the next time. So that's why I'm because the brokerage firms are not, or the newsletter writers, a good, let's sort of like capital allocator sometimes. So, we get paid, some of these guys get paid fees.
Mm.
So when they get paid fees, they're less concerned if the thing goes up or down.
Mm.
They're more concerned about getting the fee. And
Yeah.
so the more that they put out, the more fees they make. Are they filtering? No. Because if you filter, you'd make less money.
That's yeah, that's sell side. That's a sell side for you, and that's a fair warning there. You don't get paid in fees, I don't think, right?
No, no,
Okay.
we make our money from subscribers, hopefully the portfolio return, and some consulting I do on the side.
Right.
That sort of stuff. And we cover our travel costs. That's the only that the company would cover, but with the knowledge that if I don't like it, I'm not going to do anything or say anything. Um, on the other side, I try to cover my travel costs with conferences. So when I go to a conference, if they cover my costs, let's say to Peru or to Argentina or to Chile, then I could do site visits from there that the company would cover.
Hmm.
So that's how we try to cover and keep our G&A low.
Okay. So like business class and Michelin star restaurants and so on, right?
Well, truth be told, I do fly a lot business because I upgrade. So in terms of me flying anywhere, I tend to do like premium economy, but a ticket that's easily upgradable with my upgrade points to business.
Okay.
Because the amount I travel, and I've just done economy down to Argentina with my family, I couldn't do that for the 4.5 times around the world I travel per year. I would not do that in
Is it
economy.
is it worth it though? I mean, I've never flown. This is a bit of a peasant question, I suppose, but I've never flown business class myself. Never upgraded or anything. And we did 12 site visits this year. I think about 10 mining shows, so quite a lot of travel as well. Just all economy though. And is it worth it? Business class?
For what I do,
Mm,
it's a must because I actually do work in business.
okay.
So I've got everything there. I don't have to worry about somebody grabbing my spot, or something like that, or somebody putting their chair back and then my computer gets stuck in the seat. It's impossible to work. And so because we deliver the letter every Sunday, some of those Sundays I'm traveling. And so it's a real hassle sometimes. Like I had on this economy trip, there was no Wi-Fi for the entire trip. So if I didn't deliver the letter, which we did before we left, that would have been a risk. And
Yeah.
that's a risk I can't take. So whenever I do any travel, I tell the company, you got to be okay giving me at least premium economy, and then I can apply for an upgrade. So there's certain airlines I would travel with that I have the points with to actually do the upgrade.
Hmm.
So we don't do as well
Yeah.
as a letter like some other people. There's less froth in what I do. So like I was telling you about those returns, yes, I did make a 15 bagger on that company, but I'd owned that company for 8 years. The other ones that I've done 3 times or whatever, I bought last year. You know, um, but I'm not getting paid by anybody. In terms of, hey, talk my company up or blah 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 blah. Because what we try to do is make sure that when we present, you know, uh, I don't need a company that embarrasses me because my reputation whatever it is, I try to I hold that in high regard. If nobody else does, I do. And so I don't want to be associated with companies that might do something that might embarrass me. And so that part about management scrutiny and all that is very important. So I'm willing to pay more for that. That's not a problem. Because I don't want the downside where they do something that does embarrass me. And then they say, meaning my subscribers, well, Jesus Christ, what the hell happened there? And then I go, oh, yeah, I sort of knew that, but I knew the share price would go up, but I knew that that guy was problematic. So I can't own the problematic person, so, and then when you look at risk return, the same way you could get a 10 bagger sometimes is you can end up with nothing.
Yeah.
That's the risk profile. That's the volatility of the market. It's not asymmetric that it's going to be zero or a 10 bagger. It's going to be 10 bagger or zero or negative. So you got to think about that. There's downside to this, obviously. Not everything's going to go up. But in this market that's so buoyant, that sentiment's falling, everything is going up. Mm-hmm. So it's hard to know if you do it by returns or valuation that that's the one to own because everybody's got the same valuation.
Yeah. It goes back to incentives, actually. This is a fascinating conversation that we probably do a whole podcast on in and of itself, but it goes back to incentives. So the person you're hearing about a company on or from, what's their incentive? Are they being paid, per piece? Are they who's paying them? What's really going on? Do they have a position? How much do they pay for that position? So on and so forth.
Yeah, we're basic. Humans are very basic in terms of what's your incentive, what's driving you. Mm-hmm. It's usually not, for the good of the world. Let's just say it's mostly materialistic, which is fine. I got no problem with it. But then I got to look at how they're compensated. So you can get a company that you go, oh my God, there's a banker. He's the CEO. He knows how to sell this company. It needs to get sold. But then if you look at the way he could get paid, it doesn't really matter what price he sells the company. What matters is that he sells the company because then he makes 5 times his salary. Mm. And then you go, whoa. So if he sells it for a 30% return, a 50% return, or a merger of equals, he gets paid the same? Yeah. Then where's my incentive? Because I'm still dealing with that equity denominator.
That's right.
And the asset numerator. Mm-hmm. That's how I make my money. But if he makes his money, we're not aligned, that way. And the other issue is the independence, because we know that whatever a company is going to tell us is going to have the best bent on it. And that's what they're supposed to do because they're selling. We did that at Newmont. I worked, with Newmont, and sometimes I helped out the IR people. At Phelps Dodge, we talked about the market, or, a positive bent as we could. Don't use that word, use that word. But then when you look at it, you got to think, well, not what are they telling me, is what are they not telling me? So if it's high grade, does that mean it's low tonnage? If it's big, does that mean it's low grade? If they're talking about in-situ value, is there a problem with metallurgy? All those sort of things are what you got to take a look at.
Yeah.
When you're thinking about something.
In what they tell you, look for what they're not telling you. That's actually,
again, they're going to put the best foot forward, but you're not interested in that foot. You want to look at the one they're hiding.
Yeah. And there's even more money to be made in feet than it is in mining, but that's probably a different topic in and of itself.
Yeah, and the more a company raises, and the more times it raises, the more fees these guys make. Mm-hmm. And investment bankers, especially in the resource sector, aren't a great filter.
Yeah. Joe, is there a segment that you think is still overlooked today within the things that we're talking about? Prospect generators or royalties or brownfields, something else that you think is overlooked relative to the metals prices?
Well, when you have a positive market environment, access to capital, then a pure explorer will get more time from investors than in a bear market, because a pure explorer will have to raise its own money. A pure explorer will have to go to the market. People will take notice or won't take notice. Much more risk. So when the market is bad, people will go to the prospect generators or the royalty generators or those sort of companies. But when the market is good, then they want 100% of the project. They don't want 30% or 40% or an NSR. They want all of it because they're able to do it themselves. Uh, but the downside is that if the market turns and they have to raise money again and the market's not there, the prospect generator or the cash flowing royalty guy can raise the money or has the money to spend, but the other guy won't. And that's why a lot of these guys nowadays don't raise money for one field season anymore. They raise money for multiple field seasons.
Mhm.
And remember that when you raise flow through, there's a expiry time on that money. So if they raise a lot, they're going to be drilling a lot, which is great for news flow, but they're not going to have that money next year. It doesn't roll over. So you got to know how much hard dollars they have. So once you know the hard dollars, you got a better idea how much you're going to have to raise next year or for the next field season, because they might have, let's say 20 million, 20 million, and 15 of that is flow through. So you know that they have to spend all of that by a certain date, which might be in 12 months. Okay, so what are they going to do next year? Because now they got 5 million of hard dollars, 1 million might be G&A, so that's only a $4 million program, but nobody wants a $4 million program since you just spent 15 last year. So you know they're going to raise. So even though working capital wise they might look healthy, and they probably are, lots of news flow, but when they start getting good holes, share price goes up. Cash flowing, non-cash flowing companies will always be in the market to raise capital.
Mhm. Yeah. But also the capital raises that we see this year, it does look like late cycle behavior, if you will. So things are getting big,
But you
financings
got
are
to look
getting.
at the structure of the financing. So if the market is good and people are still issuing warrants and they're still taking a decent discount to their share price, then you got to know, well, what's wrong with that project? Because in this market, if you got a good asset that everybody wants exposure to, they'll be raising close to their price with no warrants. And now what's nice about the new life sort of financings, they could trade it right away. And so now with the life, at least, there's more due diligence done because there's no 4-month hold. So it comes free trading right away.
Mhm.
So it's more like the ASX in terms of that, which is better because then people have to do more homework on these guys.
Yeah. Is it still reasonable even to use warrants in this market, this day and age?
Well, some people still have to issue them because that's the only way people will give the money.
But isn't
So
that
some
already telling you enough about the company that you?
Absolutely.
Yeah.
Absolutely. It's like reading the tea leaves. If you look at the financing that people do, when they do it, the timing, how much they raise, how they do it, that sort of gives you an idea. Okay, if we think about what we do as gaining value through share price accretion, share price is two things: a numerator, the asset, which is most of the due diligence, and the denominator, which is the share structure. Both are direct linked to the management team. What assets they pick, how they develop them, what comparative advantage they have in terms of advancing them, and then in terms of the denominator, what access to capital they have, how they time their capital, who are their shareholders, who's willing to give them money when times are bad, when the retail market's not there. That all comes into it. Those people are able to raise significant quantums of cash. That's the asymmetry in the market that continues to this day. That's why the P50 and the mean of a lot of the raises and the valuations are so askew. That kurtosis is generated by those management teams.
So you don't think it's late stage financings that we're seeing right now? I mean, the size of it all and everything. I mean, fewer people are
I've seen
using warrants. I
companies
mean,
that
not
I
every.
own. I've seen companies that I own that have taken a second trip to the financing trough. Why? Because they can, and you never know when the market's going to turn. But in terms of what they raised, still a significant quantum. The price they raised, a significant increase from the last time, and still a significant increase to my entry level.
Mhm.
So am I sad about that? No, because I know that money is going to generate catalysts, whether they're exploration catalysts or development catalysts. And I believe now that, with respect to the orphan period that we all talk about, that orphan period, if you pick the right development asset, those, and that's what we have had. We've had a silver developer do very well, a rare earth developer do very well, and a copper developer do really well. And the incentive there is that there's fewer developers out there that make sense, that could do it themselves as well.
Mhm. Yeah. So that's what I'm thinking about next year and kind of reading the tea leaves again. Is like who raises capital? How do they raise it? If everybody's able to raise capital without warrants, is that maybe a top signal? Even the people who
Yeah,
weren't.
if,
Yeah.
if you knew an asset with a shaky management team that you knew that you would never invest in,
Mhm.
and they're raising money with no warrants at a small discount, no flow through, no nothing like that, then that's saying something.
Yeah. Yeah.
We might have already seen that. I haven't looked at all the financings, but I've seen a lot of people get funded that already suggests a bit of a top.
I
But the
think
problem
per
is that
definition,
we're
yeah.
going into a commodity price that's still buoyant if they change the US Federal Reserve chairman. Right now, we're baking in two more cuts potentially next year. If we don't get those two cuts, that could turn the gold market, at least in the US. Will it change the central bank demand? No, probably not. So there will still be some support for the gold price. Um, Silver price, we talked about the idea of substitution, the idea of scrap, the idea of people trying to take some money off the table. But in terms of the assets, I come back to the fact that there's not a lot of silver dominant assets in the development phase or advanced exploration outside of Mexico and Peru.
Yeah.
And if you're concerned about those jurisdictions, there's not a lot to choose from.
Well, and we still haven't gotten to jurisdictions, so I hope you still have more time to go.
I've interwoven that into the conversation.
One last thing though. Um, when is it going to get toppy? And you might recognize that on, based on the financings. But if we are seeing what you just said about, tech bros potentially coming into this space and any kind of rotation, I'm not particularly big on that, but any kind of rotation from tech, Bitcoin, whatever it might be, into mining, even very, very small, there's going to be a lot of new kind of uneducated retail coming into the space. So things might get way sillier than you would have, things can look silly to you. And then, 2 years down the line, they look 20 times sillier, but
Yeah, but
so
look
do
at the
prices.
valuations for the S&P. Look at the valuations of a lot of these AI companies, the kind of PE ratios they have. They've already gone silly over there.
Yeah.
We look a lot less silly,
Mm-hmm.
right? In terms of cash flow multiples and things like that. So they might look at it that way, exactly like you're thinking. But for them to invest, again, it's a liquidity issue. They can't dip their toe into some of these pools. They're not big enough.
Mm-hmm.
And they have to have almost an ocean-sized liquidity for them to consider investing. And so these guys have to get higher and higher. And that's what I was talking about before, is that that's what we might see, is that some of these companies going up a different liquidity level, whether it's mid-tiers combining, whether it's Newmont buying the other half of Barrick or whatever, and them still doing well. And when you're thinking, wow, that's getting kind of toppy, that's our knowledge of toppy, not these other people's
Yeah.
thinking what's
Yeah.
toppy. But still, I would say if you want to avoid any issues, because asymmetry is the game we play, still do your homework. still look at what people want. And if we're talking about Silicon Valley, they're less interested in precious metals, more interested in critical minerals. And then also they have another layer of that they're interested in the application of technologies, high tech to mining. So if you're still old stage tech, that's not their investing scheme. They're interested in the cobalts of the world, the private companies that are sort of applying AI to exploration and mining. They're not interested in potentially in the Rio Tintos or the Freeports of the
Hmm.
world.
Yeah.
The crypto guys, they're interested, especially the stablecoin guys, interested in tethering currency exchanges. Like they're not looking at Bitcoin like that as a separate thing that has its own life. They're more tethering to, okay, the US dollar, Canadian, US dollar, euro, US dollar, whatever. We just need to replicate that. Then they're doing gold. So gold, Tether has been one of the biggest buyers of gold recently, at a level of what central banks do. Why? Because they're setting up their own reserves to support their own Tether gold coin or whatever they call it. But now that interest has like now trickled into equities. Their equity model is more for precious metals, but the model they like is the royalty model. They love the royalty model. Why? Low G&A structure, big revenue stream. Lower technical risk, and they just hold it and just keep adding. So different strokes for different folks. The only thing I would recommend people do when they get into this, we've got a lot of players in it now, which is good in terms of liquidity, but you really have to understand their motivations as well. They won't have the same motivation as an investment banker working for a brokerage firm, high net worth retail, or anybody else. And they'll have different motivations.
Yeah. Jurisdictions. We might as well start talking about that. Otherwise, it's never gonna. Otherwise, we'll be talking for 4 hours or something like that, which I think we did one time, or was it 3.5 hours? Which I don't mind, by the way. But I know you've got nice weather there in Argentina to go and enjoy. Which countries changed this year for you, better or worse? Let's start with better. What changed for the better in 2025?
I had a list. There we go. So last year I came to Argentina 3 times, I think it was, in support of the government in Mendoza, because when I worked here, Mendoza was like off limits and had been basically up to recently. Nobody wanted to work there because the government and the people didn't want projects. They still banned cyanide. They still banned acid, like in terms of doing an SXCW for a copper project. But now there's more interest in copper and more in concentrate projects. So in a certain part of Mendoza, there's a lot of interest. That's suggestive of where that province is that was formerly against mining. Also, the people that are supporting it are interesting. And it's the wineries that are supporting it, and a lot of people that were against mining before. And why is that? If you look at Mendoza, when I lived there in the 90s, did very well. The best infrastructure versus, let's say, San Juan to the north, better infrastructure, higher population, did very well with tourism, did very well with the wine as well. But now, as Mendoza has gotten bigger, their tax base can't pay for the infrastructure required. San Juan, through mining, has done much better. You drive the road that goes from Mendoza to San Juan, the quality of the road changes a lot going into San Juan. And so you notice that. It's palpable. And so now Mendoza wants that. But the wine companies don't want to pay more taxes. Tourism can't afford it. So they have to let a new player in. The oil and gas industry in the southern part of Mendoza hasn't been doing well. I mean, the big project right now in terms of oil and gas is Vaca Muerta, but that is in Neuquén, a couple provinces to the south. It's not in Mendoza. So they're also not getting that benefit. And so now they're looking to mining. So that's good for Argentina. But state-wise is one thing. The bigger deal for me is I'm investing in companies in Argentina that are in the best provinces. The best provinces are San Juan, Salta, Jujuy, Santa Cruz, probably on the bottom end. So I've loved Salta for the longest time. I've worked there, I lived there, and that project is in Salta. So Salta is very good for mining and has been for lithium for the longest time. But now the problem has been that it needed big companies, Chinese state-owned companies, the Rio Tintos of the world, because it was hard to repatriate funds out of Argentina. A smaller company could not get a bank loan. Nobody would lend to any company in Argentina because repatriation funds were difficult. Under this new reheat plan that the new government, Milei, has put together, reduces corporate taxes, which is nice, eliminates duties, which is huge. But most importantly, for the developers and the smaller companies, it allows the repatriation of funds. And now suddenly they have access to capital that they didn't have access to capital before. And now there's more money potentially that could flow in that doesn't have to be from the biggest of the biggest. Mm-hmm. It could be from the smallest, or the intermediate companies could build projects. Yeah. And so I see projects that I hadn't seen before. God, Agua Rica has been around for as long as Bajo de Lumbrera, never been built. Now Glencore is talking about putting that into the reheat plan. They're talking about putting Pachon in. Azules, I think, is already in it. Rincon, a lithium project, has already been accepted. So a lot of these projects are trying to get into the reheat plan now because you have to qualify. Yeah. But everyone's trying to get into it as fast as possible. Yeah. So I think that's a positive for Argentina. But when are these projects going to take off? When is copper going to get? I have no idea. But it's a positive in terms of exploration and development for Argentina. On the other side of the Andes, Chile has been held back by the left-wing government there. It's been harder to permit, harder to deal with water issues, harder to deal with a lot of things. I talked to the guy who was the president, I believe, of the Chamber of Mines there a couple of years ago when I was at PDAC. And he basically said, well, they stopped talking to the left-wing government. They said, well, we're just going to wait till he's changed. That change has happened. So the new president left wing of Chile is now swung, which is typical of a lot of these countries and not unusual now in other countries, whether it be Belgium or the US or Canada, has switched to the right. And, now suddenly a lot of guys are looking up on Chile. As Chile's forcing a lot of other companies to divest their land holdings if they're not going to explore or develop, it's opening up inroads for smaller companies to look at exploring and developing projects in Chile. The desalinization plants that are being developed in a lot of the major drainages help people look at water because they can't touch the water from the Andes. Nothing potable, and compete with the farms or agriculture. They're going to have to get it from somewhere else. So they either got to wait for that desal plant to be built, or at least put their hand up that they want some of it. And solar power in Chile has been a phenomenon for them. So they've been doing very well since Argentina cut off the natural gas back in the late 90s. So those are two. I would suggest Kazakhstan, where we've both been. That's been improving. Ivanhoe Electric has gone there, and I see a lot more bigger companies there. And I would say the U.S. Federally, the U.S. has been problematic to permit, taken a long time. Now that they're making it easier to permit exploration development with fast tracking, forcing people to actually meet their timelines with respect to permitting from the government point, I think that's a positive. We've seen the share price impacts from companies like Trilogy because of it. The issue would be for me is that some projects who have both, let's say, local First Nations opposition, ranching, tourism, and a lot of other opposition locally, I don't think the federal government can change that. So those projects may never get built. Other projects that was just a technical issue, like why the reason that they gave a permit for the road to Trilogy and South 32, then took it away, that didn't make any sense. And so that got changed, and that I think is a positive. And then accelerating the development of the projects that make sense, and then loaning them money. That could be the Perpetua one in Stibnite in Idaho. It could be hopefully like a nickel copper project like Talon's got Tamarack in Minnesota, which is not in the boundary water drainage. All those sort of things make US a little bit more palatable than it used to be.
Yeah.
Negative, which I know you're going to ask.
Yes.
British Columbia has gotten more problematic, especially for exploration. I did a piece about that for my subscribers a couple of weeks ago, and I'll do a piece about that for a Rick Rule event about the Golden Triangle. So that has gotten more problematic because the majority of British Columbia, when it was formed, British Columbia at the time was led by people that never made agreements with the local First Nations. They interpreted all the ground in British Columbia to be like unceded, meaning that nobody owned it.
Yeah.
So we owned it. We being the people that took the company over. Now we have to make these discussions saying, okay, we're on unceded territory, blah, blah, blah. But now everything's coming to roost because we have to make all these First Nations agreements. And the question becomes, when you introduce the ILO 169 Acquis, the DRIPA, the Declaration of the Rights of Indigenous People, here, what does that look like? Does that go from consulting people to requiring their consent to having vetoes? That's what's got everybody worried. Mining companies, explorers always had agreements with First Nations groups. They always, because otherwise they couldn't get access. Everybody knows, if you talk to anybody in exploration here being British Columbia, about some areas, they'll tell you, oh, no, you can't work there. That drainage, they don't want touched. So they'll look at that negatively if you start staking ground there. They'll look at your company and go, oh, yeah, we won't deal with them. So that's why don't touch that one. But now these companies now have to go consult them. And now they have to look at it, and sometimes they don't get back to you. So before you could stake ground and know you had it like that. Now you could wait 3 to 6 months and not know. And they hold that money that you just paid. I mean, it's not a ridiculous amount, but you don't get that cash back until you find out if you get it or not. And that could be a long wait. That didn't exist before.
That's right.
And then the other problem is it could be no, which definitely didn't exist before. So yeah, that's a problem.
Do you feel like British Columbia is uninvestable?
No, I mean, that company I just talked about that did very well, they have their ground. They drilled it. They made their agreements with First Nations. So if you can invest in a company like that, make sure that they have all their agreements. When they say, oh, when we still got to talk to those guys, goes, well, when is that happening? Inquire a lot more, because because once these guys, and I don't mean this in a negative sense, but I do mean it in a negative sense, get the power that the BC government, which is left-wing, is giving them, they might apply it when they didn't think about applying it previously. When you give somebody a gun, they might shoot it off one day. They're not just going to keep it in their desk. And the problem is right now is we're supplying that. And that's not necessarily their issue. It was the people that colonized originally that never made any agreements. This is not a problem in Ontario. This is not a problem in Quebec. It's a problem when we say, 95% of the ground in BC is unceded. We're having a problem right now in Vancouver with building houses. Some people, we thought we owned the land. Now we don't own the land. I go, well, hang on a second. I got my house on that.
Yeah.
And can you build a pipeline? That continues to be an issue. Like Alberta can build that pipeline up to the border, but then until BC gets its agreement sorted out, they can't connect it to the ocean. And that's gotten a bigger deal now because if you look at this projects office that Canada has developed, most of that's liquefied natural gas and most of that's British Columbia. So the British Columbian government, which is left wing, are saying like, oh, stop that pipeline so we can make agreements on these other LNG projects with other First Nations groups, because if you push that one, suddenly we can't push these because that's like, another $5 billion, whatever, but a lot of money are going into these LNG projects. Some of them are mining, but the big ticket items are still energy.
Mm-hmm.
And those big ticket items depend on the same things that the mining companies depend on. These First Nations agreements, these benefits agreements. And if you don't have them, that's more problematic, especially in British Columbia, parts of the Yukon, which are unceded. So, ask.
Are those issues as in, are they manageable or are they complete deal breakers?
I can't get into the head of some of these people. I don't know what their thinking is. And it could be something sacred to them that is non-negotiable. I don't know that. I have nothing sacred. So we don't have that kind of a personality. We haven't been around that long in terms of this territory. They've been around forever. And I don't know if it's just a whim. What we want to avoid is the whims that say, you know what? Yeah, I shot a moose there 10 years ago. I'd like to shoot it again. Like, hang on, buddy. We want to put a pipeline here and this is going to be important. That for me is like that Alaskan road. That it was okay. They didn't talk to 3 groups that maybe have 50 people that live there and they don't actually live there. And then suddenly they decide that they don't want it because they weren't consulted. Mm-hmm. That can't happen.
Yeah.
But some of these things might have legitimate reasons. But legitimate reasons, black that area out and let us go around with respect to a pipeline. And if it's legitimate reasons, black that area out, nobody will stake it. But what I don't want to see is that some of these First Nations groups giving that to somebody else that they might have a deal with, that they might gain a royalty from, negotiating. That can't happen. That company that staked that ground should get that ground. They can't make an underlying agreement with somebody else. That's not how this should work. But the problem is that might be how it works.
Yeah. Is it manageable though? Again, to ask, what are you looking for? If you're looking into, like, you really love the project that a BC exploreco has, what is it that you're looking for? Their relationship or agreements, or what is it that you're again looking for there?
I'm looking for a impact benefits agreement. I'm looking for good relations with the First Nations that are all that ground they have. They've got an agreement with those people. Not 5 people and we don't know these people. No, that can't happen. That's a risk. Mm-hmm. But that's sort of like an underlying risk on metallurgy. Could be an underlying risk on mining dilution. Could be any kind of risk. Because then if you know that, you can buy them on the exploration stage, see it go up, but know in the back of your head, you got to sell before everybody else does. Yeah. Why? Because they still don't have all their First Nations agreements. Like, I've got a company up in the Yukon. I'm pretty convinced, rightly or wrongly, they can get an IBA and a benefits agreement. I'm pretty convinced that it's not going to be an issue, And when it comes out, it might be a major catalyst for their share price. But for me, it's like a major catalyst for them, but not necessarily me, because I'm convinced that should happen. but that might drive the share price up anyway because, maybe people aren't buying it because of that, you know. So it's something that has to be weighed into whatever you do. Is it a deal breaker? Depending on the project. That's the extra level of due diligence you got to do because the local government, the NDP, and the provincial government has made things very strange. The next time we have elections, will the NDP win? There's a new sort of consortium of more center to right people that hopefully can form a group that's palatable for voters that can that can form government. And could they retract all the policies of the NDP? Yes, probably. But that might take a little while. But in the interim, right now, that's something to think about.
Yeah. What is a jurisdiction that you think might surprise you next year? Is it a place where you thought never touching that, but it's kind of going in the right direction, and you think it's going to turn? I suppose it might be again in South America, given the move from left leaning or lean completely.
That's
right.
definitely Chile and Argentina definitely switching, and that's definitely related to government elections that you can't know until they're done. But there was definitely a move. Like when I was in Chile, and I've been in Chile a few times, knowing that it's going to swing to the right. Knowing that it was swinging to the right, I invested in a company in Chile, knowing that those issues that they had before may not be issues anymore. And with respect to the one in Northwest Argentina, I knew that was a great province, but it's hard to buy a developing asset when you can't repatriate funds. Where are you going to get the money from? I knew this was going to change. So that's helped. Now we don't need M&A. They could build it themselves. So that has been a positive for Chile and Argentina. If we go back to problematic, the problematic is we're not alone in seeing the move in gold price, silver price, and other commodities. Jurisdictions see that. And when they see the increase in revenue, because everyone can read, hopefully, the financials, and they can see how much money some of these companies are making. So they're saying, well, Jesus, shouldn't we make more? And so now I see a lot of jurisdictions that I thought were safe, like in Africa, that suddenly, I don't know what the policy is anymore. Do they want a bigger stake? How are they going to negotiate the bigger stake? What does that look? Could somebody be, this project in this province, in the state, like I'm talking about places like Namibia that I thought were like great. Like, could new regulations make them not necessarily uninvestable, but problematic for M&A? That people go, well, why would I give 50% of the asset away? Why do I need to? Because some of these countries, even here in Argentina, this one project in Patagonia that's getting built, a small heap leach, 80% of the labor has to come locally. And with any kind of mining, there's certain parts of mining that there's just no local people. That wouldn't be 20%. Sorry, not 80%. They could probably get away with getting people outside that would fill that 20% and enough employees that would maybe be 80%. That might not always be possible in terms of the labor skill sets, that you need to train. And that's what this company has had to do, knowing that to get the permit to build the project, they had to train a bunch of people. At Newmont, we had to do that in Ghana. There was no way we were flying in expats, for that long. We trained locals to drive the trucks, to work at the plants, to do all that. And that's an investment you make for the long term, knowing you've got a 20-plus year mine. But those sort of issues come in terms of creeping nationalism, when people start saying, oh, wow, look at how much money these guys are making. We should get a bigger piece of the pie. And so stable jurisdictions that have a mining law that people follow and don't change every couple of years, that can be important, especially when you're investing in development. especially when you're investing in a producing asset, because that could change, in heartbeat in some jurisdictions.
Would you dare go into some of the war-ridden jurisdictions like maybe East Africa? There's a lot of geological potential there, but there's yeah challenges.
Yeah, I guess the way I think about it is if the big companies are there, if there's M&A, I can take that risk of going to a place. But when I went to Egypt, granted there was M&A there at Sukari that got bought out by AngloGold Ashanti. I looked at it and I thought, geez, I mean, there's a lot of military involvement. There's a lot of, government involvement, not necessarily good, that I found it kind of problematic in terms of who do you know, what, security issues, all that sort of stuff. I saw that on the ground, and that stuff would never hit the newspapers.
Mm-hmm.
You would not know unless you knew. And so that got to be problematic. I had one company recommend this one jurisdiction that I thought in East Africa. I thought, oh, yeah, that looks interesting. Exploration level, same belt, blah, 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 blah. They held back their private placement because there was a war. And I thought, you know what? That's fine. I'm not going to do this again.
Mm-hmm.
Because I mean, I just got all giddy about the geology without thinking long term in terms of, could this happen? Yeah, it definitely could happen. Do I want to be woken up in the middle of the night, it happening and having a bunch of subscribers asking me about it? No, I don't want to be a political observant in my letter. I don't want that to be what the letter is about. Yes, we look at macros. Yes, we look at government involvement, which is more so now in terms of capital. But I don't want to be looking at, where the next military coup is, map out where all the ISIS camps are. That's not what I want to get into.
Mm-hmm. Do you think, given where the market is that even a thing? Would you think about different geologies in different markets? Like, would you go chasing after porphyries specifically now because they require more capital and capital is easier to come by? Is that even in kind of in your thinking process? Does it matter?
In terms of deposit style?
Yeah, deposit style relative to the type of market we're in.
Yeah. Okay. If we take copper, let's say I'm bullish on copper, which I still am. How do you leverage yourself to copper? Go by
Mm-hmm.
stage, and I'm in all stages.
Yeah.
But on the cash flowing part, I'm in a royalty company. Okay. So I'm not in a producing company yet. But I'm in exploration and development.
Mm-hmm.
But then I look at, okay, what size could it be? So on the size scale, with respect to some exploration companies, I'm looking for big. I'm looking for porphyry size that a big company would want, right? But also, there's a lot of intermediate M&A, as we were talking about, but it's also in the copper sector.
Mm-hmm.
They don't need the huge project. A smaller project would still have a material impact. So I also look at those because we've seen some incredible valuations for high grade, smaller tonnage projects. But problematically, some of those underground projects, the capital intensity has been a lot higher than people thought. Think about what happened with Foran recently with their capital changes. The project in Black Butte in Montana with Sandfire. So that can be problematic. They go, oh, well, that's going to be underground, low throughput, high grade, blah, blah, blah. And then you think, oh my God, the underground development's a lot more than I thought. Access is going to be whatever. So maybe open pit's better. So how many open pit projects are there? So that's some of the thinking that I'm doing with respect to copper. And then what's the product? Is it a concentrate? Where does it get shipped to? Is there infrastructure to take it out? Or is it cathode? Like that's problematic to find cathode. But if I do get cathode, I get it in the jurisdiction I want. I hold on that like dear life. That's the one I want.
Yeah. Is it Is it market dependent though? So would you go chasing again more for VMSs because it's a slow market, or more porphyries because it is, or is that the strategy that you just outlined that's just always your strategy, or does that change with the market as well?
Yeah, like one of them's a skarn. Uh, One of them could have VMS sort of implications. Most of them on the exploration style are porphyry style. That would be more to a big company. Um, yeah, VMSs are like skarns, as they could be problematic in terms of continuity. So continuity is the big issue with those because when you're dealing with grade, it usually is a continuity issue. And their issue would be, has it been faulted? Usually with VMS deposits, they tend to form in layers, cumulate layers, and they tend to form in clusters. And if they've been geologically, if they're old, which most of them are, they'll get folded and faulted. And so the drilling it needs to be more intense. Skarn deposits have their own geology and how they work. Understanding the chutes of high grade, the structural components, very different from porphyries. So each one has its different motivation. I'm looking more for, if it's a certain deposit style, do these people understand that deposit style? What is the upside in the deposit style? How dense do they have to drill to prove it out? Because some of these projects, you can have to drill it out a lot denser than you want. And then you find that they can't access capital to drill it any denser than they can. And that can get problematic for gold deposits as well. When they have a high variability, grade variability, and the QP, the qualified person, requires much denser drilling to put it into indicated, let's say, for a feasibility study or pre-feasibility study, the market doesn't want to give them the money to drill it because suddenly those 8-meter centers are too much. Suddenly it's got to be a 100,000-meter drill program. And the market they sell in the scoping study. Okay, that's it. I'm out. So there's a lot of thought into it, and it's not as much about the deposit, but some is dealt with the deposit in terms of continuity in that skarns, VMSs versus a porphyry, which could take wider spacing to justify its resource.
Mm-hmm.
That's not necessarily the case for VMS or skarns. And especially if it's got a gold skarn or byproduct credits, because those also might have a different variability than the copper, might not always be in the same place.
Right.
So yeah, lots to think about. And probably
That's a 2 hour podcast for you right there. There's always lots to think about. What am I forgetting to ask you though? What is the presentation you did there was pretty good. We touched upon, I think, a lot of the topics in there, and just an overall 25 recap, 26 outlook. What are we forgetting? What else should we be talking about?
I would say one of the big things is resource sector thought of as an alternative investment sector. So people are looking at alternative investments, and that could be gold physical, but now it's spilled into equities. But as I told you, with Silicon Valley venture capitalists versus the cryptocurrency people versus the government in terms of financing these companies, they're all looking at different commodities. The cryptocurrency guys are definitely focused on precious, mostly gold. The Silicon Valley venture capitalists concerned mostly about critical minerals. And the government is mostly critical minerals. So different strokes for different potential capital focus. So the capital available to some companies, like a critical mineral company, may not be available to a gold company. Mm-hmm. So the way Perpetua was able to get its letter of intent from the Export-Import Bank, which was for a significant part of the upfront capital required for an open pit high grade, but metallurgically complicated, requiring a pressure oxidation circuit, autoclave to extract the gold, was driven by the low cost of capital from the 10% or less of antimony it had. That's what dragged the government in. It wasn't the gold. So the combination of having a critical mineral that the government wants, like antimony. You can get gold antimony deposits, but you make your money off of the gold, and the gold is going up, but the cost of capital is going down because of the antimony. That's a perfect environment right now.
Mhm. Probably a topic in and of itself, and probably a podcast in and of itself, and knowing how much I like to annoy people, probably a topic that we could spend 2 or 3 hours on as well. But let's leave it here. Happy New Year, Joe. I appreciate you stopping by. Thank you so much for everything you do.
Thanks, Antonio. Happy New Year, and we'll see you in Vancouver.